Hi, I'm Ela Lange, co-host of the Dollars with Sense radio show and podcast, here with my fellow financial guru, Terence Vanderwood.
Hi, everyone. Welcome back to another great episode of Dollars with Sense. If you're tuning in for the first time, comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Contributing to your Registered Retirement Savings Plan, or RRSP, is one of the most beneficial and efficient ways to both save for retirement and reduce your annual taxes. Since the beginning of the year, Ella and I are dedicating our shows around RRSPs and continue to remind you March 1st, 2017, it's coming up, is the contribution deadline.
Thank you, Terence. That's right. Today we're talking about how conservative investing has its risks, as inflation can erode your investments. Yeah, being too conservative can actually cost you money and not grow for you at all.
Yes, we spoke about a little bit on a couple episodes ago called opportunity loss is what it's called when you're being too conservative and costing you money. And while you think playing it safe protects you from investment losses, think again. Sometimes the price of playing it safe can actually erode the value of your money over time thanks to inflation. Certain investments like GICs, it is often thought of as being safe, but today they may not keep up with the pace of inflation, especially after taxes. The best way to ensure your investment stands the test of time is by investing in a diversified portfolio that offers competitive rates of return.
So, out of curiosity, this week I checked out a few current promotions going on with some of our major banks. So you'll see up on your screen now, for example, if you're watching our podcast, what the CIBC special offer is. Grow your savings faster with a premium of 2% interest rate. That's right. Benefits of a GIC special offer. And
so here, a GIC is a guaranteed investment certificate. Both Ella and I are not big fans of the GIC, and we'll continue talking as to why. But the only guarantee of a GIC is that the bank gets to keep your money. So as you can see, the little penguin there is having its ice cream and is just about to dig in, but what it doesn't realize is that the inflation is going to melt it all away.
Okay, and then so I pulled up, here's another one, the TD's Market Growth GICs earn up to 11%. What? 11% with a 3-year TD Canadian Banking and Utilities GIC. Interesting.
Wow, 11%. That's great, right?
That's right.
Let's look at the details. Maybe it ain't so great. So it's 11% GIC with 3-year. So what they say is 11% is how much you would earn of a maximum over the 3 years. And just a little bit about the Canadian Banking and Utilities GIC. So Canadian banking is a big part of a portfolio for any investor in Canada. Here at Investors Group, we have a specific fund that we've had since 1962. It's called the Investors Dividend Fund, and it's highly invested into the financials of Canada, so into the banks, TD, or CIBC, Royal Bank, etc., etc. It invests in all the banks. Last year, the return of the Investors Dividend Fund returned on average around 15%. Now, we go back to the TD GIC, and it's giving you 11% over 3 years, right? So that's about 4%, 3.75% or so, which is the maximum it will pay. So the 3.75 is what they pay you for that 1 year, but they made 15%. So the bank gets to keep the extra 12%. So that's why I say the only guarantee of a GIC is that the money gets to stay with the bank. Ella's just going to take a little bit closer look into the GIC details of the TD GIC.
Okay, so the investment minimum, if you're putting it into a non-registered account or a TFSA, is $1,000. If you put it into an RSP or an RESP, it's an education savings plan, you're asking for $500. And it says it's not cashable, not cashable. I'm going to say that one more time, folks. That's not cashable, which means you can't take your money out.
what you're saying is you're guaranteeing that the bank's going to keep your money because it's non-cashable?
That's right. That bank money stays in the bank. So looking further down, as per the advertising, I looked at 3 years. The guaranteed minimum interest rate has a rate of return of 0.75%. 0.75%. They were suggesting that the maximum return is 11%. That's the maximum of how much you can actually make. But let's look down further. The next slide you'll see the guaranteed minimum interest rate, 0.75%, actually means the third point there in fine print says 0.2504% per annum. That's compounded annually, payable at maturity, which is equivalent to 0.75 total percent return.
Yes, and as you can see, there's some red markings on there. It looks.
It's my heart for Valentine's.
Well, it's in a GIC, so it's probably more like a broken heart. But you can see where Ela's talking about where the check marks are, the equivalent of the total return over the term of investment, and then the actual return is 2.504% per annum. Compounded annually means that they only apply that rate once a year, and payable upon maturity. So they don't even add it to how much you own. They only add it at the time of maturity. So we have one more here that Ella's going to go through. Last one we couldn't leave out Royal Bank because we've got to have at least 3 good examples. So Ela will take you through that one.
RBC has a plus take advantage of special GIC rates here advertised. Again, same options, guaranteed 100% of the original amount that you invest, while at the same time earning investment at either a fixed or variable rate or based on a predetermined formula. So if you scroll down, you can see a cashable rate advantage. So cashable at each anniversary. First year, you'd earn 0.75%. Second year, 1.15%. And third year, 1.5%. And get that, when you see a little bit further down where the asterisk says you have access to 20% of your principal annually.
So you're telling me that I'm going to put my $10,000 into the RBC and I'd put it in November and I can't do anything with it until next November, including seeing how much money I'm making. And then next November, I've got, one day where I can go in and say, I want $2,000 of my $10,000, 20%. Yep. That's crazy. So what do we mean that GRCs aren't safe? Guaranteed investment certificates are always promoted as safe. But guess what, everyone? The only real guarantee about the GIC, as I said before, is the bank gets to rent out your money for very little. Yes, they actually rent your money because they are using your $10,000, let's say, and they are lending it out to other individuals. And that's the model of the bank. So let's say you have $10,000 and you put it into a bank or credit union. By law, the banks can lend out $9,000 of that $10,000 for different purposes. Perhaps a mortgage, perhaps a business loan, a car loan, or for a credit card. With that credit card, they will charge, let's say, 20% interest, for example, and pay you, in the case of the Royal Bank's highest GIC rate of earning of 0.5%, currently posted on the website. That's 19.5% profit that they get to keep.
That's right. So a business model for all banks in general, basically, and credit unions for that matter. And this isn't to criticize banks, by the way. We are just educating you guys and presenting a few of the promotions going on around GICs at the moment so that you really do read the fine print and understand what it is they're actually offering when they talk about rates of return. When you invest that same money with us, you actually become a shareholder of the banks and other companies. So when they report making, let's say, $1 gazillion over this quarter, you will know that some of that is going to you as a shareholder. Not only that, the Investors Group business model is based on a commission wage that is based on the growth of your money. So essentially for us, the more money you make, the more money we make. You can see the motivational difference, which is huge. Coming up on our screen now, Terence is going to talk to you a little bit more about the Investors Income Plus portfolio.
Yes, this is one of our, we've probably got about 10 specific funds that are geared towards the conservative investor, as you can see there. So the investor's income plus portfolio has been around since 1990, so it's got quite a few years of growth to it, and lots of data that we can take from that. So looking at your screen right now, you're going to see quite a bit of information there. We're just going to focus on the calendar year returns ended in December 31st. So you can see there's one that says 1.9%, and just below it says 07. That means in 2007 it returned 1.9%. In 2008, the year of the Great Panic, it returned negative 5.7%. Now, this is considered conservative because those who were in the opposite end of things, the aggressive, that year a lot of people lost 40 to 50%. Then you can see in 2009, it gained 10.9% and continued and so forth. So those are all the returns at the end in December. Then let's focus your eyes a little bit farther down to the next block, if you will, called the rate of returns. And you can see the returns and the quartile scores. We're just going to look at the returns right now. And the returns are 1 month is 0.61%, 3 months is 0.92%, year to date. This one's year to date is all of 2016. So it's 5.57% is what the rate of return is. The 1 year rate of return, again, would be 5.57%. 3 years, so over 3 years, every year it's given 3.23%. And over 5 years, it's given 4.05%. 10 years, 3.0. And then you skip along to the end. Since inception of the Series A has been 4%. So that's over the long term. So since inception is since 1990. Oh, sorry, 1989, as Ella's just pointed out to me. January 16th, 1989 is when it began. So the moral of the story is that this is the typical for our conservative funds that we have here. But guess what, folks? You have access to it whenever you want. It is not locked away. There is no withdrawal fees. There's nothing attached to it to stop you from using your money to spend on what you need to. Working with your financial planner, a part of your portfolio will be always protected and growing above the rate of inflation with the Income Plus portfolio.
In order to grow your wealth, the best way, as we've said, is a diversified and balanced approach, which should include exposure to higher yielding equity mutual funds. If your portfolio is appropriately diversified and tailored to your time horizon and emotional tolerance for volatility, you will ultimately be playing it safer over the long run. Boy, that sounds like a lot of mumbo jumbo, I know. But again, well-diversified portfolio has a balanced exposure to a variety of funds invested in different sectors, kind of like a cocktail, which only tastes great when mixed with the appropriate ingredients and quantities, right? And that's
right.
Tailored to your time horizon. So again, either 3 years, 5 years, 10 years, and so on. And again, your emotional tolerance for volatility. So in other words, how much markets go up and down, meaning what are the unrealized gains and losses? Because again, you don't realize a loss unless you sell. These factors have to match your own personality and your own goals.
That's true, Ella. It's very true. Everybody has unique emotional response to money and risk. Market experts agree, and us as well, being the two financial gurus, and decades of investment statistics show, more importantly, that a diversified investment portfolio with a balanced amount of different assets is the best way for investors to reach their long-term goals and dreams. I would go so far as to say the key to wealth growth is diversification. Equities, which are publicly traded companies, including equity mutual funds, play a key role in achieving the highest returns of your portfolio. Here's how and why a diversified investment portfolio can help buffer market turbulence. Asset classes tend to move in different directions. Asset classes are energy, are consumables, are financial, are pharmaceuticals, etc., etc. And asset classes, as I said, tend to move in different directions. By loading your portfolio with a single asset class, like if you put it all into energy, you concentrate your risk and limit your resources of return. A well-designed, adequately diversified portfolio encompasses all asset classes, which can offset the downward movement of one class with the upward movement of the other.
And nobody knows in advance which asset classes will outperform or underperform, or when. So because asset performance is constantly changing and the asset allocation process is dynamic and fluid, investors are best served by covering all the bases at a given time.
Studies have shown that the correct asset mix offsets selection risk. In other words, making asset allocation, not individual investment selection, is the major driver in investment returns. In fact, as much as 90% of portfolio variability, or the ups and downs of the market, can be attributed to the type of assets chosen. Since 1950, fixed income investments have generally reduced investment risk, but they have also lowered long-term growth. Over that same period, Canadian equities have produced the necessary asset growth to achieve long-term investment objectives. The takeaway here is this: even conservative investors should allocate a quarter of their long-term investment portfolio into equities. There are people in our industry, Nick Murray is one of them. He's a well-known North American financial planner who argues that no matter what stage of life you're in, you should have all your monies into equities. Because when you're older and you're drawing on those retirement, you can find equities that have a dividend payout that may not perform very well in the market, but still have a high yield and therefore give you an income to live off in your retirement.
The numbers game.
Yes.
That's our man, Nick Murray, the game of numbers. Yes, the amount of risk in your portfolio depends on your personal tolerance for risk, as well as your time horizon. So, for example, if you're close to retirement, you might want to reduce risk to protect the capital, as that's the money that you need to spend of your investments from inevitable periods of market volatility. So you got to be in preservation mode. If you're between the ages of 25 and 40, that's our millennials and plus, these are your savings years when your expenses are usually higher and you have less to invest. So on the other hand, you have a longer time horizon to retirement, so you can choose an aggressive investment strategy that includes more volatile investments that may go down in the short term, but may produce higher returns in the long term. And be sure to maximize contributions. This is what we're talking about. This is the time to maximize on those contributions if it makes sense to your TFSA or your RRSPs.
If you are between the ages of 40 and 60, these are your wealth building years. Your debt hopefully is down or gone altogether, and you have more capital to invest. As your retirement nears, consider redirecting your portfolio into lower risk fixed income investments. Continue to make max contributions to your RSP eligible investments. No matter what age you are, you need to determine your personal capacity for investment risk. And how do you do that? You ask yourself fact-based questions like this. What is my investment time frame? If it is less than 4 years, don't invest in higher risk assets. If you have an investment horizon beyond 10 years, experts believe that you, and we do, that you should invest in a more aggressive portfolio because historical trends show that over the long term, being 10 plus years, you will benefit from a higher rate of return with ample time to recover from the short-term volatility. A really good example of that short-term volatility was back to the Income Plus portfolio fund fact that we showed when 2008 was in a negative of 5%. So, and then ask yourself the other questions about risk tolerance is the feeling-based questions. In other words, You ask yourself, can I sleep soundly at night? Regardless of your investment horizon, the way you feel in the short term when the markets go through a severe decline will not change. Feeling-based questions should serve as a tool to prepare you for what you should expect and focus your logic and emotions to identify a consistent pattern of how you perceive investment risk and what you are realistically capable of withstanding. I often refer to it as the sleep at night factor.
The biggest mistake investors make is to overstate their comfort level with risk, because that often leads to abandoning their investment strategy at the first sign of volatility. When you choose the right strategy from the start and stick with it, you'll be rewarded over the long term. Of course, you should revisit your portfolio and investment strategy as conditions, financial, and life goals change to keep in tune with you. So with so many different types of investment products, different asset classes, as we've seen, and different industries and countries, and determining the right strategy can be daunting. But that's what we're here for. At Investors Group, Terence and I provide you with an investment questionnaire, which is a great tool for identifying what your personal risk level is, and helps us create a framework for constructing a sound and well-diversified strategy for just you.
Now, let's talk about inflation. Yay! Inflation is a long-term tendency of money to lose purchasing power. This means that the current value of your money generally diminishes as time goes on. Now, $1,000 is still $1,000, no matter what point of time you are in, but current value refers to what types of goods or services, or groceries, let's say, that the same amount could buy currently versus what it will be capable of to buy at a future date.
So what you're basically saying is that 30 years ago, you could buy a loaf of bread for 70 cents, and now you need $2.19 to buy that same loaf of bread. The rise in the price is because of inflation, and which now over the past 30 years equals to 7% per year. Shocking. And that means that the price of bread has tripled. Whoa. Now, imagine that with $10,000.
That means now it costs $30,000 for the same thing if it had the same rate of inflation as the bread did. Now, Canada's rate of inflation for 2016 was 1.2%, and that's an average of all costs of all goods, everywhere from universities right through to how much it costs for a liter of milk, and it's averaged out. So 1.2% is what it was for 2016. The average of the last 15 years has been around 2%. So again, that means now what it was $10,000, and if it's a 7% rate of inflation, that means now it costs $30,000 for the same thing. So basically, the longer you hold on to your money and don't have it invested, stuff it under your mattress, or put it into your checking account, it's going to be worth less. So why do we have an inflation rate, Ella?
That's a good question, Terence, but will take us completely off course if we go into that today. But if you have a burning question out there around this topic or any other questions, for example, you can always send us an email at 2financialgurus. That's the number 2financialgurus @gmail.com.
So my words of advice, or our words of advice, are if anyone guarantees you 11% rate of return, read the fine print. With that particular deal, it was a 3-year GIC, and the 11% rate was for the entire 3-year return. Possible. Yeah. That was the maximum. That means it was most commonly known as a 3.75% rate of return. Further to that, the actual rate was much less than the advertised 3.75% maximum. Historical data showed it actually only gave a 1.5% annual rate of return.
The really sad part is that a couple of years ago, 1.5% on a GIC return was pretty good. As a result, if you invested in a GIC, again, after taxes and inflation, you actually lost ground.
Yes, and same goes for the savings account sideliners, we like to call them. In fluctuating markets, some investors choose to sit on the savings account sidelines or keep it in as cash, which at least partially contributes to the fact that there is, in 2013, $670 billion sitting dormant in Canadian savings accounts. By sitting it out on the financial sidelines, these investors missed out when the market began its steady climb, while those who stayed invested capitalized on the upside of the market and reduced the impact of short-term volatility. The market moves fast and often with no warning. Strong gains can easily be missed by sitting on the sidelines. We can take a look at the chart that we have coming up now called the What's the Guarantee of a GIC? And basically it compares a GIC with the Investor's Dividend Fund, which I was referring to earlier. And it takes the same amount of money at the beginning of the chart or the beginning year. It takes $100,000, and then it has a regular draw out as well. You can see underneath the blue and the green is the income payout. So not only do you get more of a payout with the Investor's Dividend Fund over the 20 years, but you also end up with more than you put in after 20 years.
As you'll see, that after inflation, so GIC principal value, Investor's Dividend principal value after inflation. So put together a list of your assets. What do you own? That means what are your RRSPs, RESP savings, TFSAs? If you own a house, write down the annual rate of return that you're getting on all of those assets. And if you think you're being paid an interest, then yes, that's an asset. And with regard to your home, the growth of the assets is measured by how much you paid for it. So remember that, what it's worth if you sold it today minus what you paid for it. When you look at your portfolio, ask yourself these 3 key questions. 1, is my portfolio diversified? 2, am I achieving a reasonable rate of return, or at least better than the inflation rate? And 3, am I being too conservative or too risky?
Great. Those are 3 great action items. 1, diversified portfolio. 2, the reasonable rate of return, at least better than inflation rate. And 3, are you being too conservative or too risky? Great questions, and you can write them down and let us know how you fare with that. So that's it for today. And again, you can reach out to us to make sure that you have a great financial planner. If you do not have a great financial planner right now, feel free to reach out to us and we can hook you up with somebody that will be very good and a good fit for you. You can reach us by email at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You can phone us at 778-879-0820. That's 778-879-0820. You can reach us by our Facebook page, Dollars with Cents, where you can listen to this recording and then leave a comment for us. And we'll be able to get that and reply to you on that. And the 4th way you can get a hold of us is by our YouTube channel. Just go into the YouTube search bar, type in Ela and Terence, and we will come up at the top of the list. You can check out our 38 other episodes at your leisure. While you're there, subscribe to the channel, and then you will automatically be notified when a new episode is ready for your listening pleasure.
Thank you for tuning in today and joining us on this episode of Dollars with Cents. We hope you have found it useful, and we look forward to seeing you back next week for another knowledge-packed episode. Until then, Terence and I hope you have a productive week, and may your dollars and cents be with you.